morning, this is Stephanie C. O'Connor, Executive News Editor at Hotel Business. We're here this morning at the ALIS 2017 conference in Los Angeles, and we're speaking with David Sonnenblick and Elliot Eichner, principals and co-founders of Sonnenblick-Eichner Company. Last year at ALIS, there was a lot of concern about CMBS imploding. Did that happen? Are we seeing that? It doesn't seem like that actually came to be.
No, not at all, actually. You know, there's a big concern with the new risk retention rules that came into play last December. It was kind of interesting. December 24th, the day before Christmas, I think the government was like, I wanted to give us a big Christmas present this year with risk retention, which would require people who are issuing the loans and selling the loans to retain a piece of the loan, which arguably or theoretically would have invested in the deal. So people were wondering how much would that cost, or additional cost of borrowing through a CMBS structure if lenders actually have to retain the paper and become illiquid. And I think we initially felt that there may be a 50 basis point move in rates as a result of that, and we actually didn't really see it that much. There has been a move in rates, and I think it's been more due to the Fed move last year as opposed to risk retention, which it did have some impact. But as we sit today, there's a tremendous amount of capital from all capital sources, including the CMBS market. And though rates are higher this year than they were last year, I think what people forget is that when we looked 10 years ago, we were doing loans in 2007, 2008, when we thought we were in the best interest rate market ever, we were doing loans north of 5.5%. And today we're doing deals for hospitality less than 5%, depending upon where the indice, the swap rate, the treasury may be at any given time that somebody closes. So we're still in a great market, and we're still seeing a tremendous amount of capital.
I think we've seen on the CMBS side, to your question, I think we've seen a little bit of shakeout. So some of the CMBS lenders who didn't have a big shelf and weren't historically doing a lot, I think they're sort of out. But all sort of the bigger names in the business, they're still in. And I think in any given deal that we're looking for a 10-year fixed rate loan, and we go to the life insurance companies and to the CMBS lenders, we are getting multiple quotes, really in excess of 10 quotes easily on any particular deal. So it just shows the velocity of the lenders and their willingness to make hospitality loans.
So with that sort of scenario in place, what sort of advice would you be giving to people who are looking to invest, a buyer, a seller, an investor, someone from overseas?
Right. Well, I think on the debt side, on the financing side, we've been saying that interest rates are going to go up. They've been saying this for 10, 15 years and been more or less wrong except for the last year or two. But we still think that we're in an amazing interest rate environment. Historically, it's a very low interest rate environment. We're really not seeing any shortage of capital. The CMBS pools are smaller than they have been historically, and to Elliot's point, there are some of the smaller CMBS shops have fallen by the wayside, but the big shops are still there. You talk to them, there's a tremendous amount of capital in the secondary market to buy this paper, the CMBS paper that they're creating. And we would suggest take advantage of the market today, because you just don't really know where it's going to be tomorrow or a year from now.
Elliot, any thoughts?
No, well, we've seen spreads sort of increase quite a bit, but then taper off. So as David mentioned, we are seeing 10-year fixed rate financing sub 5%, which historically, as David mentioned, is good. It's good for any type of income producing real estate. So we think now there's a lot of loans that are coming due in 2017. We've been talking about this for a long time. We know just in our company, the loans that we put in place in 2007, a lot of our clients have paid these loans off. A lot of the fees has been paid because rates were low, and if you look back, they probably did the right thing, because when we defeased those loans, there was probably a 4% financing. But we think if you have anything due in 17, and I know now we're sort of coming up to February, we're advocates of getting out early because there are still a lot of maturities, and we think it could be a lender's market because there are so many maturities, and lenders are going to see a lot of product. So we think getting out early and getting out ahead, there's no downside to that.
And actually, that's an interesting point, because in any given pool, lenders, CMBS originators, are limited as to how much hospitality they can have in their pools. I think it's maybe 15-20%.
Maybe, yeah.
Plus or minus. So with the tremendous amount of maturities that are occurring this year, it'd be good to take advantage of the market while you can. So.
And at the beginning of the year, students with life companies, they have new allocations. So we're always an advocate of being at the beginning of the year, where the life companies have a lot of money for hospitality, because that gets chewed up as part of the third quarter they're sort of sitting on the sidelines. So for the most part, generalizing, but we think also that it's prudent to be early.
Well, there's some sound advice this morning from David Sonnenblick and Elliot Eichner of Sonnenblick-Eichner Company. Thank you, gentlemen. And this is Stephanie C. O'Connor, Executive News Editor at Hotel Business. Thank you.
Thank you.
Thank you.